The 4-year slump in China's producer price index is showing signs of moderating. The recovery in global commodity prices, as well as the construction uptick domestically, has softened the PPI's fall. China's factory prices have been falling for more than 4 years, though April's decline of 3.4% from a year earlier was the smallest since prices fell 3.3% in December 2014. The question now is, will the trend of narrowing PPI contraction continue?
Definitely this year, almost certainly, because of base effects. So perhaps PPI will remain in deflationary territory this year, but next year there is a fair chance that we reach again inflationary territory.
We're expecting the deflation in China's PPI to further subside. I think by the end of the year, our expectation is the year-on-year rating will be around -1%-ish. If there are upside risks, we could even get to close to zero.
This might ease some strains on Chinese companies, which are facing sluggish demand and high debt levels. Prices of steel and other industrial commodities have risen since the start of the year, but sharp declines in commodities futures prices recently indicate that higher prices may not be sustainable. In addition, the overcapacity problem, especially in the steel industry, has not been resolved. Meanwhile, investors are questioning whether the easing momentum may slow. Is this the light at the end of the tunnel? The economists I spoke to here all agree that the central bank monetary policy will be less aggressive in the near term and that we may only see one further cut to the reserve requirement ratio in 2016 or none at all.
We are probably one of the first houses who called there will be no more interest rate cut in China, because I think some of the stimulus policy conducted by the government has been very effective in reflating the economy. So we think the need for further rate cut has subsided substantially.
The Asian Development Bank also expects China's policy stance to remain largely unchanged in the next couple of months.
It's much less likely that interest rates will be further cut this year. For a number of reasons. Credit growth was extremely strong in the first quarter, too strong to be sustainable, and also internationally, sooner or later the Fed will increase rates, and then you don't want to be on a track of cutting rates in other countries, particularly since capital outflows are still a potential issue for China.
Analysts also worry that recent signs of improvement may be largely driven by companies and local governments taking on more debt, which could put the chances of a stable recovery at risk.